Let's get some insights in the news shaping the markets. For that, we welcome in William Lee's with us, Chief Economist at the Milken Institute. Thank you so much for being with us. So obviously, we've watched the 10-year yield, and as it moves above the 5% line, which we haven't seen since 2007, a lot of folks are talking about what this means. What does it mean to you? How could it really affect the market in the big picture?
Haven't we had some incredible volatility in that 10-year? It's gone up, it's gone down, but it has a relentless march upward. And as you say, hitting the 5% mark sort of shows that the bond market has become unanchored. Usually it's monetary policy that sort of sets the stage for where the 10-year is going to be going. If they know that monetary policy is going to continue to tighten, then of course the 10-year would continue to rise to reflect the tightening monetary policy. But right now, the Fed is talking about pausing. So if you look at the data, it turns out that the rise in the 10-year is due to the rise in the term premium. That means that markets are really uncertain about where it is that the economy and rates and the deficit's going. And given the conflict in the Middle East right now, the demands on military spending is going to be even greater, not just in the Middle East, but in Europe with Ukraine and possibly in Asia with China possibly acting up, especially as it starts to make more moves in the South China Seas with the Philippines. Then with the farce that's going on in Congress right now and the inability of Republicans to have a leadership put in place, it kind of ratifies Fitch's the decision to downgrade the credit rating of the U.S. Treasuries because U.S. has no governance. And then on top of that, we have the Fed. And as I've been saying on the show repeatedly, the Fed credibility is really going down because the five-year and forward inflation rates have been rising steadily since this uncertainty about where Fed policy is going. And essentially the message is the Fed has to change its operating system. It can't do this ad hoc, seat of the pants, day-to-day kind of stuff. It needs a more objective, focused framework to tell bond markets where it is that they're going. So those are the three elements that are really pushing the economy, the bond markets around.
As you talk about the bear steepening here, and that's a phrase that we've been hearing a lot more of lately, right? Here at home, and we watch our yields curve here at home, and the ominous influences that you noted in your notes today. At the same time, I've been hearing about Japan and what kind of moves Japan may do pertaining to its yield curve. And I was curious to, as somebody who's so fully immersed, your thoughts on what it means for markets here at home, because investors really need direction.
As Japan starts to unwind its, decades-long stagnation, it's trying its best to no longer manipulate the yield curve and trying to let market forces come back in, which is a good sign. But in a way, for us in the U.S., the Japanese JGB market is very domestic. And I think one of the things that we've always thought when I was at Citi and I was at the Federal Reserve and the IMF is that the JGB market is quite special. It really depends on where the household savings are located, whether it's abroad or at home. And so in terms of the implications for the rest of the world, as important as JGB market is, there are other forces that are really dominating the U.S. bond market right now. It's not the JGB.
Tell me about your thoughts on, obviously we have a busy week. We'll get the Fed's preferred PCE print later in the week, but throughout this week we'll have a slew of economic reports. What will you be looking for throughout this week?
Let's remember the context. The CPI inflation has been steadily rising since it hit its low last summer. And I think the PCE is reflecting that same thing. Now, the one thing that keeps the Fed from continuing to increase rates and talking about pausing all the time is because there are signs the economy is slowing down. And in a way, every time the economists say that there's a sign of slowing down and possibly recession, and in fact, the forward markets for the Federal Reserve federal funds rate is that there are cuts sometime next year, starting June, which means the economy is supposed to slow down really fast. But we've been hearing that over and over again. I have very little confidence that the economy is going to slow so dramatically that the Fed is going to have to cut rates. I think what I'm looking for is continued strength in GDP. GDP now numbers somewhere around 5%. That's probably not too far off for most estimates. But the key is to look forward. Will consumers be able to maintain their spending? I don't think so, because they are really reaching their end. Now, we've been surprised before, and I expect to be surprised again. But that's the one thing to watch out for. Will consumers slow down? Will high interest rates start to cut into housing finally? We already see business investment on the floor right now. So the slowing of the U.S. economy and the signs that ratify that thesis are the one thing that you have to watch out for. But be ready to be surprised.
Yeah. So you think the Fed pauses on this next meeting, October 31st into the 1st of November, into November, right? Is that what we're talking about
markets
here?
are
And
betting
then
on
do
it.
you expect a call?
The
I
markets are
wanted to
betting
ask
on
you
it.
about
The
cuts
Fed
next year.
never tries to disappoint the market.
Yeah, yeah. Anything else that keeps you up at night that we need to hit on that I didn't hit on, Bill Lee?
Keep your eye on the South Pacific. China is getting tired of messing with Taiwan and is starting to mess with the Philippines. So again, that's the third theater that might open up and really raise geopolitical risk, and that will push the term premium up even further because prospects of containing U.S. Deficits are really going nowhere.
Yeah, understood. How do you feel about the consumer? I mean, I know we get GDP this week. 2/3 of that would really be the consumer spending element that we've been seeing. And it's so funny because the one thing we hear versus what we see, we see consumer spending. We know that they're spending. At the same time, they're worried. They're worried about their jobs, their wages, their future, inflation, and so on. How do you feel about this consumer going into the holidays, especially when they're digging into savings, credit card rates that are above 20%? They're still facing high oil prices, et cetera.
There are two groups of consumers in the United States, or at least two. One are the ones that are scraping by, dipping into credit cards. They're really going into debt and trying to maintain their spending in the light of high inflation. But then there's that other group, the group that's going to Europe, the group that's going on vacation, the group that has a lot of savings still to spend. And that bifurcation of the U.S. Consumers into these large and widening, division between these two groups, I think is going to be a source of political risk going forward, because how are people going to vote? People who are content will vote to keep the status quo, but there's a lot of people who are in deep doo-doo, and they will want to change what's going on in Washington.
Yeah, and look, that geopolitical risk, I mean, is real. I'm glad you brought that to our attention as well. William Lee of the Milken Institute. Always wonderful to have you on the show. Really appreciate it. Thank you.
Thanks for having me.